I am Shana Orzik-Sissel, and I am the founder, president, and chief executive officer at Banríon Capital Management. We seek to be your one-stop resource for all things related to alternative investments, and that includes access, education, research, analytics, and of course, our dedicated investments officer to serve as your technical expert for all things alts. You know, I decided I wanted to come on and do this little video because I just had a conversation with somebody, a colleague from a different firm, and we were talking about some of the frustrations and misconceptions of alternatives and alternative products out there. And so I thought I might do a series where I address some of the key misconceptions. And I wanted to start with one that was prompted by the conversation I just had, which was that alternative investment products are risky. And there are a lot of reasons why people believe this. There are definitely some alternative product strategies that do have higher risk. I think that the industry has not done themselves any favor in kind of addressing this issue because, for example, there are ETFs and mutual funds that fall into that alternative bucket that are really difficult to trade. As a matter of fact, I have a friend who I help with their IRA. And one of my favorite products, as you all know, is a fund called Betel, the CAGFIQ anti-beta fund, US market neutral anti-beta fund. And, during the height of the downturn in 2022, I wanted to buy it for his portfolio. And I went to place a trade and I couldn't. And it was because this very large brokerage firm blocked trading in alternative ETFs because of complexity. Complexity required a sophisticated investor. You had to sign an additional waiver stating that you understood that this was a complex product. And you also had to change your risk questionnaire to reflect that you were an aggressive investor because you wanted to buy this product. Now, Betel is market neutral, which means it's zero beta. It's equally long and short, and so it has zero equity beta. It's actually a perfectly hedged product. So in theory, it's actually not more risky. Now, I understand that it is somewhat complex, and that makes sense, but it baffled my mind that it required that he had to sign off and say he was an aggressive investor because he wanted to buy a product that was actually hedged. And the whole point of hedging is to minimize risk and hedge downside. So it made me think that these are the types of things that make people believe these products are really risky. Yes, they're complex. That's why we exist, to help address the complexities, help clients better understand the products. Yes, it's not okay to just buy one product. In the same way that we learn how to build equity portfolios, large cap, small cap, growth value, or how we learn to do fixed income portfolios, investment grade, high yield, floating rate, government. We know that that's how you build those portfolios. In the same way, you need to approach building alternatives. And the alternative universe is massive. And I will address some of that aspect of it in another episode. I want to keep these short. But, private equity and private credit are still equity and credit. They're in less efficient markets with more opportunity for upside. But at the end of the day, they're still equity and credit. And venture capital is kind of its own animal. Again, it's still equity. That's still the kind of exposure you're getting. So when you approach building alternatives as a core part of a portfolio, you have to focus on the things that have low correlation to traditional equity and fixed income. And there's plenty of product out there. Market neutral is an example of that. Managed futures, global macro, credit arbitrage, on and on. And we'll have videos in the future that address all of these nuances. But the thing is, in the same way that you build fixed income and equity, that's how you should be approaching alternatives. If you do that, then you can maximize the potential risk management benefits of alternatives in lowering the overall risk of your portfolio. You can improve diversity of the portfolio by having these uncorrelated allocations that help when equity and fixed income doesn't do well, as we saw in 2022. And ultimately, you can add value to the portfolio and not really hinder performance. There's plenty of studies that show that if you include alternatives at about 20%, no more than 30, that you can slightly improve your overall portfolio returns during normal market conditions, but you will dramatically improve the risk profile of the portfolio. And then during periods of stress is when they really show you what their worth is. So this is the first of what I hope will be a series of videos addressing some of the common misconceptions of alternatives, and also hopefully first of many where we address some of the products and help build a foundational understanding of how these different products are built and how they work together in a portfolio with your traditional equity and fixed income. Thank you so much for listening. It's been a pleasure, and look forward to doing more of these videos. So subscribe, hit the subscribe button to make sure that you are informed whenever our next video comes up. Thank you so much and have a wonderful day.